Hi, everyone. I'm Sonali Basak, Global Wall Street correspondent for Bloomberg Television. I'm thrilled today to be joined by Marcie Frost. She is the CEO of CalPERS, which is the largest public pension fund in the United States. It serves more than 2 million members, and it has a market value of $495 billion, so really has a lot of weight in the world of investing and in the world of sustainability. Marcie, thank you so much for your time. Marcie, when it comes to sustainability, what do you find is still your biggest challenge with meeting more aggressive goals?
Thank you for the question, and thank you for having me on the program this morning. So for CalPERS, that $490 billion portfolio, when we think about transitioning the portfolio into that net zero goal by 2050, there are two things I think that are still problematic for an investor. One is there is a certain amount of data that's not being publicly released by public companies and private companies, and the regulatory environment really needs to help investors to correct that, make that data available and more transparent so that we can use it to make better risk-aware investment decisions. And then I think the second one is really around finding those opportunities. At CalPERS, we discount our future liabilities at a 6.8 growth assumption. So finding those opportunities that will allow us to accomplish that 6.8 return on the contributions and the investment earnings that are sitting in that portfolio. I think those are the top two challenges for us as an investor.
Now, let's go to the data aspect of this, because you, alongside Carlyle, one of the biggest private equity firms in the world, had made a very interesting move, drawing in many other pensions as well as private investors to start to disclose data, very specific data, among portfolio companies that your investors hold. How do you expect this data effort to start paying off for you? And what does it ultimately lead to for you in the end?
Yes, so thank you for that. Yes, Carlyle and CalPERS co-launched a program around our data convergence project for private markets or private equity. And as I indicated earlier, getting information and data from the public side, working with the regulators to make that mandatory reporting, we also knew that we had very significant holdings in the private assets in the portfolio. And so working with some of our general partners like Carlyle, there are several other GPs, a number of LPs, and that convergence around these topics. And if you think about a general partner and the portfolio companies that they hold across the various vintages, they actually have, I believe, they're better positioned to provide those metrics more consistently. So reporting out greenhouse gas emissions, reporting out net job growth, reporting out employee engagement information. Now, initially, that will be whether those companies are doing an engagement survey. But what I'm hopeful about is after we get these metrics in place, get them consistently applied across all of the portfolios, that we'll be able to get those scores being reported as well. Workers' comp injuries. And so that set of data, we believe, is something that can be commonly applied across the portfolio. There was some, people want to have a lot more data reported, but we think that these are the few to get started with. And so, right now we're in that implementation phase, getting, the general partners to be able to start collecting that data. I believe they do have that data readily available. That's my personal view, and start reporting that out to their limited partners like CalPERS. At the 1-year mark, once we start seeing this data flow in, at the 1-year mark, we'll evaluate the effectiveness of that data and whether we should monitor that differently, whether we should have new metrics, whether those metrics should be changed. And then that really invites the conversation with those general partners and the management of the portfolio companies and how to manage those companies differently to get to that transition point that we all need.
Yeah, I'm interested in this as well because, and I want to be clear, to my understanding, not even the public markets has a standardized way of getting all of this data to investors. And so to see it in the private markets where you're increasing your allocations is a big step. When you look at other pension funds as well as yours, do you think that the companies, the investors that don't start to show progress on these goals will limit themselves in terms of what capital is available to them?
I do. I think that is the end goal. We're some time away from that, but this is about making capital allocation decisions based on the risk that we think that company is either effectively managing or not. And the data allows us to get a bit of insight into that company to know whether it is being managed in a way that meets the goals of CalPERS, which is to be net zero by 2050, to look at human capital issues, look at the governance issues of those boards. So I'm excited about this. I haven't been this excited about an initiative in quite some time. I believe that this one is on the path to success. And I say that because of the demand, the number of LPs and GPs who really wanted to be a part and coalesce around these metrics. Consumer demand is going to continue to change, and companies that do not pay attention to what is important to the consumer, those are not going to be sustainable companies in the long run. And for CalPERS, our liabilities are evergreen. And so we need companies that are sitting alongside of us, thinking about the long term, not just the short term revenue growth.
Now, one piece of that data that's not necessarily about green initiatives, more of the sustainability part of this as well, is that you're looking at employee engagement. You're somehow tracking it among the portfolio companies owned by the investors that you invest in. So, I think the reason it is so relevant right now is we're in the middle of this great resignation. So I'm wondering how, employees being happy, employees being able to get what they need, employees, as we see them unionize or seek to unionize across the United States, how does that all play into your decision making here about making that an investment decision?
So I believe that employees who are highly engaged are also highly productive. Employees who enjoy coming to work, have the leadership that really sets them up to be successful, gives them the resources they need to be successful, that those companies are going to thrive in the long term, whether that is a brand of that company, whether that's the ability of that company to recruit the top talent that they need. Once they recruit that talent, are they able to retain it? And so the way that engagement surveys would need to be done is it really needs to get at the heart of the matter of what makes a productive employee. And I think I've mentioned a few. It's around leadership. It's around having access to resources. It's promotional tracks. It's a fair and equitable system for promotion. It's the culture of that company and that brand that they have, that they want to be able to net promote that to others. And so that engagement survey, the initial part of the data reporting would simply be a yes, no. Are you doing an employee engagement survey? And that would be an indicator whether this company pays attention to culture or not. And then beyond that, where I would like to see this move is start reporting out on some of the key measurements within that engagement survey that gets at employee engagement or employee satisfaction.
I want to shift gears a little bit to the green initiatives that you're undertaking. There was a report out this morning from Stand.Earth and Climate Safe Pensions Network that showed that the two top California pensions are the largest investors in the pension industry in fossil fuel companies. Now, you've long kind of met a lot of demand to divest, and I'm wondering how your conversations with the people who are asking you to divest have evolved and changed over the last couple of years.
Thank you. Yes. So the way that we explain in the report that had come out, that obviously that is a factual report, but if you look at CalPERS at almost 500 billion and CalSTRS, somewhere between 3 and 350 billion, we're the #1 and #2 pension systems in the United States. So it would not be a surprise that our holdings would be larger. But for CalPERS, we have three ways in which we address sustainable investing, and that's interchangeable with ESG in our view. But we look at engagement, and engagement for CalPERS has been extremely effective, we believe. Climate Action 100 Plus just created a new benchmark because, again, a lot of lacking data around greenhouse gas emissions, the consistency of that reporting, the subsidies that are going into that industry, the lobbying money that's going into that industry. So we now have created a benchmark through Climate Action 100 Plus, of which we started. We're now just part of the 55 trillion in assets behind that initiative. So that's a recent success as well under the engagement. The other is our policy work with the SEC, with other international regulators, the IFRS, and really seeing, because we're a global investor, it can't just be that the US is demanding or requiring certain kinds of reporting. We need this globally because we are a global investor. We're not just invested here in the United States. And then the third one is really around integration. So how do we integrate everything that we've learned through this data, through these benchmarks, through some zip code risk reporting that we just started doing on our real assets portfolio and our real estate portfolio? How do we make better risk-informed decisions? And is that an investment that will withstand our sustainability test for the next 5 years, the next 10 years, the next 15 years? And so being an entity like CalPERS that can really push the regulatory environment, can really push particular companies to talk to us about how they're transitioning. And we believe that that has been highly effective. And it's going to take more than a CalPERS to do this. CalPERS simply divesting from these assets, it simply means someone else is going to hold them who may not have the same priorities that CalPERS would have.
Well, speaking about the regulatory framework here, the SEC, there's been a lot of talk about them moving to require more disclosure, but that has not yet happened. At what point will we see that? And how aggressive do you think that we can get in the next couple of years in terms of regulatory disclosure in the U.S. that's mandated by the Securities and Exchange Commission?
Mm-hmm. Well, we've seen some movement here. Chair Gensler has, certainly this has been an area of focus for him on the mandated reporting. But, just because reporting is not mandated doesn't mean that these companies should not be doing it. They have the ability to do that today. And, frankly, we do get some of that information in more of our private interactions with public companies. And so through, our proxy, we have the ability to have our voice through proxy voting season. But the time frame of this with everything else that's going on in Congress and all of the priorities, it could be some time, frankly. But I would really encourage, public companies, private companies as well. The private companies are willing to do this for limited partners and investors. I don't see why public companies wouldn't be able to do the same on a more voluntary basis. But the mandated reporting, I believe, will take some time to get in place.
I'm interested also in terms of how you're shifting some investments away from traditional fossil fuels to alternative energy.
Mm-hmm. We've actually found a number of opportunities more on our real assets, so solar, wind power, more so than in our index funds, and 20% of that portfolio is now in renewable energy. So we are finding some opportunities around our requirement of that it has to pay us in a way that meets our expected rate of return, our ability to pay these benefits for decades to come. We pay $27 billion out of this portfolio every year to pensioners, and so that growth assumption and the growth of the portfolio is extremely important to sustain those pension benefits for those 2 million people. But we are finding opportunities. They're not coming in, maybe as quickly as we would like to see them, but we are finding more opportunities with that 20% in our real assets portfolio now in renewables.
Now, I'm wondering also, California obviously has been a place that's faced tremendous climate change pressures when it comes to the fires, for example. We have seen, water rationing in many different places. What kind of pressure have you felt personally and among constituents to move faster?
Mm-hmm. There are many people out there who I call them experiential learners, and California has certainly had a lot of experience with wildfires in particular. Tahoe, Lake Tahoe, which is just an hour away from Sacramento, and the Caldor fire that was there is one of them, wasn't the only one, and just the devastation that has caused to that really beautiful area of California, let alone the number of people who lost their homes, the number of animals and wildlife that was lost there as well. And so we do hear the pressure to move faster, and we understand that pressure. But the transition it's not one of those things that you can just flip the switch and we're transition completely this $500 billion portfolio into something that looks completely different. But we are on a path, and I believe it's the right path to get to that net zero. But there are 3 types of emissions, right? So there's scope 1 and scope 2, that if the divestment pressure about divesting from fossil fuel companies themselves, that might address the scope 1 and scope 2 emissions, but that's about 20-25% of the portfolio. Most of the emissions are in scope 3. Those are in the supply chain, and that's about 75-80% of the emissions. So having CalPERS to divest from fossil fuel companies does not accomplish the goal of being carbon neutral by 2050. We have to be involved in this. We have to continue to have a really important role in this transition.
Yeah, and obviously we've talked about this before that scope 3 emissions has been hardest to track the data for as well. This has also been a huge year where we have seen activist investors like Engine Number One come up and make tremendous change. How are you taking a more active stance? And do you find yourself aligning with investors like that more and more to create a greater change?
We do. We were certainly a part of that campaign. We felt that, the G, if you will, and ESG is around governance of these companies, that these companies are managing those risks that we've spoken about, managing the transition activities that need to occur. And we didn't believe that that was happening with that particular company, and that there needed to be more independence on that board, and there needed to be people who were thinking about that company differently, perhaps than the company, in its prior decades. And so we were part of the campaign. If we believe that it aligns with the goals of CalPERS, you will see us become a little more active, activist, but you'll see us become more active during those proxy, activist campaigns.
Before we let you go, we should take a question here from the audience. And this is coming out of COP26, obviously a landmark year for discussions among governments on the topic of the environment. What are your thoughts of the formation of the ISSB coming out of COP26 and other efforts, frankly, that might help you do your job better?
Well, I think it goes back to, this is not something the asset management industry can accomplish on its own, or the asset owners like a CalPERS. And this is something that, the global community, whether those are governments, whether those are investors, regulators, financial disclosing entities, that we all have to come together to really meet the goals of the Paris Accord and now meet the goals that came through COP26. So I'm optimistic, and it's appreciated to see the coalescing around this. And so, we'll see next year. I'm a we'll see kind of person. I'm an optimist about the future, but I'm also really steeped in reality, and these things can get big quite quickly, can get bureaucratic quite quickly. And so, as long as we set the goals appropriately, we have data to measure whether those goals are making the progress that we expect them to make, and that data is available to asset owners and asset managers, then we can make that transition appropriately. But there is a cost to this transition. There's a cost that really is the subsidies that are going in today into the markets and not pricing carbon appropriately. That's a primary goal, I think, coming out of COP26, is that we have to get ahead of that and get the incentives set up differently.
Well, I mean, that's the next question from our audience. Your broader thoughts here about the carbon markets, and you started to get into that issue with the pricing issues here.
Mm-hmm. We've been a long, staunch supporter of having pricing on carbon, and that is certainly part of our policy and advocacy work that we've been doing, probably over a decade. That it's a free ride today. We can't have a free ride on carbon. Eventually, there will be a cost to repairing the damage from carbon. Who will be the payer of that? That payment needs to start happening today. The subsidies, and I think it's subsidized in the markets. I think that there's lobbying activity and lobbying money going in that needs to also stop immediately, and really start incentivizing the markets into new innovation and new technology that will help this path to move, faster than what it's projected to move right now.
We're getting one last question for the audience, and it aligns with what I wanted to ask you, is what about next year? What about the 2022 season? And they're asking specifically in terms of proxies. Do you have any thoughts on what next year brings?
We will continue our work around board diversity. That's an extremely important priority for CalPERS. We know that more diverse boards, more diverse companies have better productivity and better, they're better managed, better innovation. And so that will certainly be a top priority for proxy season. We will also continue to ask companies around the independence of their directors. That independence is important as well. But those would be a couple of priorities for us.
So companies with the super voting shares, there's got to be a day and time for you.
Dual class shares are always, yes, dual class shares as well. That's something we're very watchful of.
Yeah, interesting. Coming out of California, as we know, the San Francisco companies have had a lot of that. Anyways, lastly for you, Marcie, before we leave you, 2022, I mean, if you could set one goal to kind of hang our hat on into next year, what would that be to look out for you for?
I think it's around implementing our new strategic asset allocation. The board approved a very different asset allocation for the next 4 years. Adding in 5% leverage at the total fund level, adding additional 5% allocation. We're currently at 8, adding another 5 to get to 13 for private markets. And just being able to successfully maneuver the portfolio into that new strategic asset allocation. The other, I think, for us is really the workforce, and the workforce here at CalPERS. We're coming back into the office, starting our transition more fully back in after January. And then for the markets, I think it's really watching interest rates. There's different debates about what people think interest rates will do, what will happen with this, new variant, what happens with the continued increase in the Delta variant. And so there's some known unknowns out there. But for us, it's really implementing that new strategic asset allocation and reassuring the 2 million members that their pensions will be sustainable.